Ajay Singhania, MD and CEO of EPACK Durables, joins in right now on the show. Ajay, thank you so much for taking the time out and being with us. By the way, just so that I don't make a mistake in the future, when I introduce you, should I call Ajay Singhania or should I say Ajay DD Singhania?
Both are okay.
Either is fine. Okay, great. So, okay, thank you so much, Ajay, for joining in. Now, tell us, 3 days ago, we saw a note from a brokerage which said that in North India, where the rains have ceased, they have made up almost 100% of the RAC demand which was lost in those first 6-7 days, and West and South will now start seeing that as rains cede. Are you sensing that in your channel checks, in your conversation with companies and possible demands that companies would be laying with you?
Yeah. So good morning. First of all, yes, definitely the GST bonanza, I think it's clearly visible and the channel checks are in line with what the industry reports are. So pan India, it seems 30-35% kind of growth in September has definitely happened. And now that most of the channels have liquidated the overflow of the inventory, they've started demanding. So there is a lot of primary being done by the leading brands. And then those primary is again translating into RFQs for us. So yes, definitely we see a very positive sign. And the RFQs for the next season, which were earlier kind of subdued or precautionary considering the unseasonal rains this year, but now most of the brands have again renegotiated or have started looking at a better, bigger RFQ.
Sorry, so when you say next season, right, do you mean the current next 3 to 6 months, and do you expect demand to pick up for the next 3 to 6 months for primaries and thereby for companies like yours as well?
So it's a pull system. So when the inventory from the channel is pulled, they demand the inventory from the brands, and the brands in contrast demand from us. So it's all a pull system. So now that the channels have liquidated most of the inventory, they have started demanding. So this primary from the brand to the channel, and then brands who manufacture or who had inventories are also liquidating. So they have started at big fresher RFQs for the coming quarter. October as well, and then also because for us it's mostly Jan to June season, so the seasonal requirements also being relooked at or are going upside.
Okay, Ajay, good morning. Hiral this side. If you could also quantify this impact for us in terms of volumes. A lot of analysts are pointing out around 8 to 10% additional volume growth for FY26. Is that which aligns with the EPACK Durables, or do you think it'll be much, much better than that? And what number would you look at?
It will be too early to comment on numbers, but considering the first 6 months of rains and unseasonality, I think there was a lot of negativity in feelings, and then we were all looking at if we could even break even or be flat over the last year. But now this positive has definitely put a lot of has definitely charged us, and we are looking at definitely a growth in AC quantities. But on top of it, I think the small appliances and others also being Diwali products are seeing a much bigger sales and much bigger demands. So that's a more positive side for us.
And if you talk about market penetration as well, for room air conditioners, are you seeing that penetration increase in tier 2, tier 3 cities as well? And that's the kind of expansion that you're going to see from a sales perspective?
Definitely, this GST is going to now help us penetrate further into the tier 3, tier 4 cities. And on top of it, we are also expecting as an industry premiumization happening. Now that earlier, if like 3-star was the choice of the customer and 5-star being a slightly costlier product, there was a trade-off. Now that 10% reduction in price will definitely promote the premium product. So 5-star definitely is one category we are eyeing that will grow much faster.
One question. Okay, Ajay, one question I have in terms of liquidity and the working capital cycle. How does this actually improve that aspect? Because initially we were talking about 18% rate on GST, raw materials at 28%. So there was a mismatch happening on that front, which was impacting the working capital cycle. How does that improve for a company like yours? And two, do the cuts actually translate into any positive impact on the EBITDA margins rather than just a reduction on the MRP?
I think the most positive side of the GST reduction is the working capital for us. So the raw material earlier was at 18%, finished goods at 28%. So whatever in credit days we used to pass on to the customers, the investment in GST was from our side. So now that both are in line, the differential GST or our working capital will definitely reduce over the period, and this will lead to a better working C2C cycle and all that. So that is, I think, the best part of this GST reduction. And in terms of EBITDA margin improvement, definitely we believe that currently, because of a lean previous 2 months, most of the brands or we are trying to liquidate the inventory. But going forward, we'll also look at definitely rationalizing a lot of margins. So that could be the second step. But currently, I think the priority is to get over the inventory and then create liquidity in the system.
All right. Ajay, your July 2025, when you did the con call, your commentary was that the RAC industry will return to growth in FY26. The guidance was 10 to 15% for FY26 and long-term story of 20% CAGR. Then you didn't know about GST. Now that this has happened, you've seen the early signs. Are you changing this outlook for the current year and for FY26 as well, which you had earlier guided to 15%?
So definitely, yes. Current year, earlier we were expecting a best case of a flattish kind of a year. I think now we are definitely looking at a growth of 10% for the industry. And then overall next year, 15-20% growth earlier from, I mean, there's definitely an upward trend in everything we are planning currently. And I think that's the kind of energy this has brought to the industry.
Nice. Any chance of, how do I say, any chance of a revision in capex plans as well?
See, now a lot of it will depend on the outlook we get in next 3 months. I think this is a very critical period for us, wherein we are discussing with the brands day in and day out. So looking at the unseasonal rains and then this typical nature of the business, most of the brands or a lot of brands which were earlier planning to expand their manufacturing capacity have decided to reconsider their decisions and focus probably more on balancing in-house manufacturing as well as outsourcing. So that kind of decisions will definitely impact our capex cycle as well. So in all, what I feel is that a lot of brands are reconsidering decision to invest on their own and probably balance their supply chain so that their dependence on EMSs remain equally important.
Okay. Coming to you in terms of the non-AC segments also that you have, are you seeing any benefits that are flowing in on the back of GST? Because you're talking about small domestic appliances, which has seen a growth of 16%. Your large domestic appliances has seen a growth of 29% in the previous quarter. What is the kind of booster dose that you're seeing on these two segments as well?
So most of the brands I understand and I believe have not only reduced, passed on the GST on the larger appliances like AC, but they have also kind of passed on certain benefits to the market in this whole Diwali bonanza thing. And that is also promoting a lot of smaller appliances. So a similar kind of growth is also seen in the other appliances, be it the small domestic appliances. And then a lot of import substitution, which has happened over the past few quarters, has led to new energy in the market to promote the Make in India kind of product. So we see overall demand in all the smaller appliances as well.
Sorry, Ajay, I just wanted one clarity to the earlier question that I asked. I'm sorry for going back to that, but wasn't your earlier commentary that you will do about 10 to 15% for FY26? So if you're saying 10%, are you revising the growth downwards?
No, I mean industry, which earlier was looking at 10% growth, is now definitely looking at a 15 to 20% kind of revision.
For FY26?
Yeah. No, FY27.
FY27. No, for FY26?
26, we're maintaining a flattish to a best of 10% case. Now we'll say 10% of a minimum to a higher side of anything.
For the industry and therefore for you, because I think on your con call, if I'm not wrong, you had said that the industry will return to growth in FY26. The guidance is about 10 to 15% for the year. Am I wrong?
I think FY26 is the current year. So we were always talking that this year best case was a flattish to a best percent, and then definitely returning back to 15 to 20% in the next year. Okay. So I think there's a return of almost 10% on the entire chain.
Got it. But net, effectively, this first 9 days, 10 days have shown that there is a demand boost that is coming in, and it will probably spread across the country as well.
And on top of it, we are still to see the bonuses flowing into the employees and all that. So that will keep on pushing the demand even for the next 3 to 4 weeks, definitely.
Okay.
So this is the beginning. The Navratri was just the beginning. So we'll see a lot of cash coming in the hands of the consumers. So that will again keep pushing the demand for the current month as well.
Well noted. Okay. Ajay Singhania, thank you so much. Needed that update. We got it perfectly. We look forward to talking to you post your earnings season as well. Thank you so much, or your quarterly earnings as well. Thank you so much for joining in today.